This is TreppWire Week in Review for week ending September 9th, 2022. I'm Martha Kocher with Trepp, a data modeling and analytics firm for the CMBS, commercial real estate, and CLO markets. I'm with Manus Clancy, Senior Managing Director, and Lonnie Hendry, Head of CRE and Advisory Services. This week, a big focus on the energy crisis in Europe after President Biden pledged that the U.S. will send more natural gas to the EU. No real big economic data this week, so investors could ruminate on last week's job report and a parade of Fed speeches that essentially say the central bank is keeping the focus on reducing inflation. Manus, in general, there was a lot of news coming out of Europe this week.
Yes, there was a lot of news out of Europe this week, starting with the passing of Queen Elizabeth, 70 years as the monarch of that nation. Countries in mourning. You could see the visuals of people flocking to Buckingham Palace to pay their respects and so forth. But, the negative headlines go far beyond that event. I think that the tone of the market turned exceedingly negative this week. We were talking about this internally at Trepp this week, whether you're talking about very micro issues on the commercial real estate side or macro issues, the tenor of the market has been uneasy at best, maybe. And I think that there is this growing realization that the problems emanating from the war in the Ukraine will be bigger than we had previously anticipated. I think the impact on food will be considerable, and obviously energy is already at the top of the list in terms of concerns for people. We were talking about this before Haley hit the record button, but somebody this week was calling it potentially the Lehman moment, that people in these countries were not going to be able to pay their energy bills. Accordingly, the energy companies in these countries would face liquidity issues, and they would have to be bailed out by the government. And if that happens, there's really no telling where it goes from there. Certainly, Putin this week was puffing his chest out and talking tough about limiting the supply of energy going to Europe, and that he would continue to do so until such time as sanctions were lifted. And that's never a good sign. So, and all of that contributed to a lot of worriness this week.
Yeah, man, I think the way you phrase that of realization is exactly what's happening. We've had a lot of headlines that we've talked about over the last couple of months, but people are actually starting to see the effects of the war effort. And so, you mentioned the utility cost. It's been reported that utility bills in Europe are expected to rise 80% next month. So we're talking about, single digit inflation in the US, maybe low double digit on some of our energy and food. Talk about an 80% increase in utility cost. That's significant. That's moved the needle. That's life-changing for a lot of people. And when you have, Putin saying, not just that they're going to restrict the supply, but I think his exact quote was, "We will not supply gas, oil, coal, heating oil. We will not supply anything." If he lives up to the rhetoric, that could be really scary for a lot of people. So there's definitely a somber position in the market right now. Finland and Sweden, kind of to your Lehman Brothers comment, they announced a $33 billion emergency liquidity facility Sunday to help backstop utilities through loans and credit guarantees. So again, not small potatoes. 33 billion is a pretty significant kind of initial outlay of government help. Not that we don't have some challenges in the U.S. There's some stuff that we've seen over the last couple of months around higher temperatures, lower water levels. So if you're out in the West Coast, California declared a power emergency on Monday. If you look at lake levels across Arizona, California, Colorado, New Mexico, they're all at significant low points. And people are coming up with emergency plans to stop, the fast, rapid decline of water in those lakes. And what's interesting there is that's kind of a twofold issue in the sense that when you have a water crisis, obviously you can't produce enough water for all of the users, or there's risk of not being able to produce enough water for the users. But a lot of those reservoirs have dams that are using those rivers and waters and lakes to create electricity. So if they get to a certain point where those generators can't generate electricity, it's going to be really, a double whammy for us. So, not great news there. If we go to the market, there was some corporate news this week. Cineworld, we talked about that a few weeks ago, threatening to file bankruptcy. They actually filed on Wednesday. They're trying to get about $5 billion worth of debt under control. And you mentioned this last time, Manus, since it's a Chapter 11 proceeding, they're effectively going to be able to hopefully improve or, selectively renegotiate some of their leases and get in a more favorable position. A couple of other highlights here. Citi had a small number of staffing reductions on its mortgage team, so less than 100 people. But if you look at their mortgage business, they've seen about a 15% decrease in the first half of 22. So, again, not great news. On maybe a positive note, Apple did unveil its new iPhone. So I guess for all of us that have iPhones, that means now that if you have anything less than an iPhone 14, your old iPhone is now going to start working at about half capacity, and the battery magically is going to stop working or taking a charge. So not great news for this household.
Well, we'll talk more about the Apple a little bit later. But going back to the Europe and the gas thing, two thoughts about that I want to stick with. For most of the summer, maybe all of the year, I've been a glass half full guy. And the glass half full comes from the fact that to date, I've never seen anything in the US economy that could metastasize into something bigger than what I would call a mild recession, right? And, the signs were there early in the great financial crisis when you saw companies levering up 30 to 1, 40 to 1, 50 to 1, that there were signs there that things were going to go sideways, right? The bets that people are placing, the lack of liquidity, the lack of strength in the balance sheet of the banks, all of those things conspired to create the great financial crisis. As we went into this crisis, whether you think it started in February or June, I didn't see that trigger that could take down the US economy. And when you look at the US economy as a kernel, which it isn't, obviously, it's a huge part of the global economy, but the US itself is, I still would place my bet on that mild recession side of things. But where it gets very interesting, and not in a good way, is in what's happening in Europe. And two things can go really sideways here. One is when you think about an economy, and this, I think somebody was writing about it this week, maybe Zero Hedge, that the leverage you get from oil that you import is probably 500 to 1, right? If your inbound oil is turned off, every industry that you run is turned off. You can't produce anything. So if that were the case, and if Putin were to play real hardball on this front, you could see a country in Europe that is 501 levered to oil coming into the country to power its industry completely closed down, right? That's fear number one. And that kind of leverage would dwarf what we saw with some of the banks that went under, or Lehman Brothers or others, right? To be honest. The other side of it is when people start making threats like this, mistakes can be made, right? And that triggers more hostilities, more people being dragged into it, God forbid, a catastrophic event. And so, I think that's what everybody's keeping their eyes on right now. And it's not a happy place.
I don't necessarily disagree with you, Manus, but to try to bring the mood up a little bit, we've seen these types of threats before. We've seen, the potential for things like this that could spiral out of control be on the table before. And it seems like in most cases, cooler heads prevail. The economic engine that is, generally keeps things in motion. And so I think for all of us, let's just hope that, maybe with the passing of the Queen, there's a realization that there are people, there are lives at stake there, and we're seeing it with the folks in Ukraine. I mean, we should be focusing on, things outside of war and threats and this stuff. And so I'm hopeful that, and we'll talk about this in the pod today. I mean, the transaction market, the economy, the things that keep production moving seem to still be working. And as long as we can kind of keep that some semblance of normalcy, then hopefully some of this other, more negative rhetoric will just pass by and cooler heads will prevail.
Yeah, to be sure, I was quite a downer just a moment ago. None of the things I'm saying are predictions by any means. They're more a reflection of why the market has such a negative tone right now. And until we see more lightness coming out of Europe and some of this rhetoric tampered down, I think those worries remain. I'm certainly not thinking the worst case scenario will play out in Europe. It's only that it's not off the table. And I think that that's what's worrying traders. But we do have NFL football tonight. So before anybody turns us off for negativity, there'll be happier moments in this podcast, I assure you.
Yes, unless my fantasy football team does terribly. So before we go on, we're gonna discuss Outlook for the rest of the year, and we'll see how that goes. You wanted to comment on the Apple iPhone unveiling, I think.
I was just reading those things. It's amazing what they put into all of the iPhone and iWatch releases and stuff like that.
Yeah, I think maybe we should have asked our Apple Watch before we got on the show today what's going to happen with the economy. Maybe it knows what the Fed's going to do in the upcoming meeting.
I should have warned you. I looked at my Apple Watch biorhythm and it was at a triple negative this week. So listeners could probably tell already. They don't need an Apple Watch for that. They just need to check my tone of voice.
And the good news is you can get the new iPhone here in the US at the same price as the other one. So good news there.
Yeah, are they absorbing that, or does that just mean they've been overcharging us for all these years? Are they absorbing the inflation hit, or they've just been overcharging us?
Yeah, no comment. I think they're charging higher prices in other countries to make up for the delta. So on this note, and boy, did we come out of the gate on a downbeat, let's do an outlook for the rest of the year. I know last week we discussed the delinquency rate and had some discussion about that. What do we think the rest of the year for commercial real estate and CMBS looks like?
So let's go through the 5 property types. I'll start with the easy one, which is the hotel market. We've seen extraordinary rebound over the last 9 months in every metric. Delinquencies have fallen, cures have soared, refinancings have come back. RevPAR is up in almost all markets. Occupancy is up. We'll have another story tomorrow morning at TreppWire about a big Ashford portfolio where DSCR going from 2021 to trailing 12 months as of June 30th almost doubled. So I think in that area, we're going to see more improvement in all markets other than New York, Chicago, Portland, and a few others.
Yeah, I would maybe take a slightly contrarian view to that and say, I think hotels have generally benefited from the pent-up demand from the pandemic. And I think a lot of people maybe had trips and things booked coming out of the pandemic that they're, still taking at this point. But if I were to look at it objectively, with the way prices have gone on airfare and other things, like I don't know how sustainable like this bump is into the future, especially if interest rates and things keep rising. So I agree with you, definitely a shining light coming out of the pandemic. I would maybe have a little bit of caution around, hotels in specific markets where they've seen an increase in tourists or an increase in travel, maybe not being able to sustain that on the go forward. Because if you look at occupancy, some markets are actually at higher occupancies now than they were in 2019. And I don't know if there's anything underlying the fundamentals that truly powers that into the future.
Lonnie, doubling down on the negativity on this podcast. We could have record low listenership between you and me this time. Martha, you want to throw something in there?
Yes, I noticed that New York had occupancy that was driven by a lot of European travelers this summer. We did not see the same number of travelers from Asia. So I think if that continues, and we just talked about Europe being very stressed with high utilities, high prices across the board, that could really put a damper on some of the leisure travel that we're seeing. And, I think the jury's still out on the corporate travel, right? Companies are trying to scale back costs. They're trying to find ways to shave footprint of their office space and that sort of thing. So if it becomes too costly for them to have salespeople on the road, I think you'll see that number probably not come back as heartily as we'd like it to see.
Well, you've heard about weird things over the last 20 years, like medical tourism, where people go to foreign countries because they certainly can't get the same medical care, or sometimes to jump the line in terms of treatment options going from one place to another. I wonder if we'll see climate tourism this year, people just shutting down their homes in Eastern Germany and flocking to the south of France or something like that to, get warmer weather and avoid costly heating bills. We'll have to see how that goes.
Lonnie's going to leave Dallas and come to New Jersey, I'm sure.
There you go.
I think right now I'm living in an airplane, not even in a destination. I mean, it's like just in the plane as much as I'm on them.
So Lonnie, let's give you the first crack at what I would consider kind of a tough one right now, multifamily. Why don't you give us your roundup there?
Yeah, so I am actually optimistic on multifamily. I think multifamily has, persevered through the pandemic, maybe with the exception of industrial as probably the most sought after property type. And I think, the first half of this year, we've seen maybe a little bit of tempering on rent growth in certain markets. But on the whole, I think multifamily is well positioned into the future. It seems as many units are being added in the top, 25 MSAs across the U.S. are being absorbed as quickly as they're being added. So I would say my outlook for multifamily for the rest of this year and probably even into next year is positive. I think rent growth is tempered a little bit, but I think it continues to grow. I think new units maybe slow down in terms of ground up development, but the ones that are already in flight get absorbed with really minimal impact to the overall marketplace. I think the one potential downside for multifamily is just in these secondary, tertiary markets or markets like maybe Phoenix that got really bid up on prices over the last couple of years. They have a little bit of a reset, but I think those are going to be, selected and in just particular markets, not for the industry as a whole.
Now, it's interesting. I would have agreed with you 100% until about 36 hours ago. And in the last day and a half, I've gotten 3 individual emails and 1 news story from people kind of taking the glass half empty position. 1 in California, 1 in Texas, and 1 in Pennsylvania, all saying to me that they're starting to see hints of uptick in delinquent loans in the multifamily space, which I was shocked by. Because even though I thought all along, and I still believe this, that there'll be buyer's remorse, that they bought at the market peak, I don't see delinquencies coming. But I did have 3 people anecdotally kind of saying they're starting to see a little bit of churn there. And then we saw a piece in Commercial Real Estate Direct today where they said some of the loan brokers and property brokers are starting to see a real fall off in the bid. Whereas I think the quote was in one of the pieces was in the Commercial Real Estate Direct piece, whereas you used to get 20 bids on a single property, now you're down to the low mid single digits. And so, like I said, earlier this week, I thought, full steam ahead on multifamily. Now I'm starting to hear a little bit of negativity.
Yeah, I think that's definitely plausible. I mean, you have almost every multifamily property's probably traded hands at least once in the last 5 years, and in some form or fashion had some sort of either facelift renovation or full-on renovation. And for a lot of folks that are kind of midstream right now with interest rate pressures and other things, like I could definitely see there being some pockets there. So that'll be interesting to watch and kind of play out and see if that's a hard reset on pricing or if some folks, get a little underwater, but they're able to get out without being hurt. That'll be interesting to just kind of keep an eye on.
What about industrial?
I don't know. There's much to say there. Lonnie hinted at it a second ago, talking about, how much demand there is. I think that that's going to be another terrific performer, contrary to some of the concerns that people had 3 months ago that Amazon was going to level off or decrease their footprint. Just no signs on the immediate horizon that there's any fall off in demand. So I think that's the 2022, 2023 winner.
I think industrial, gets the headlines ripped from Amazon. So everyone thinks Amazon is indicative of the industrial property type as a whole. And quite honestly, it's a very small percentage of the overall industrial pie. And if you look at the Class B industrial, it kind of powers full distribution, manufacturing, warehousing, et cetera. Like it's really, really in a good position. So I think industrial is going to be, continue full steam ahead.
So retail.
Yeah. Retail, Martha. Retail is interesting. I think retail almost has to be broken down into some specific categories because if you lump, the malls and the regional malls into that mix, they obviously bring the whole down. If you kind of parse them out and say we have the mall sector and then we have other retail, I think you might have a slightly different perspective. So it's interesting. I read a couple of articles this week that said malls have actually come out of the pandemic stronger. Our financial data wouldn't necessarily say that, but the article was contending that people have been able to leverage, new technologies, kind of the curbside pickup and some other things to strategically increase foot traffic and sales, but not necessarily, we're not necessarily seeing that across the spectrum. So I'm still pretty adamant. If you're a Class A mall, you're probably okay. If you're not a Class A, you're probably not okay, at least into the medium term. For grocery anchored retail, I think we're probably in a pretty good spot. For folks that have, a movie theater, maybe they have a big box retailer where we've seen huge inventory gluts over the last couple of months, you might start seeing some challenges there if consumers continue to cut back on some of those discretionary spending. The inline spaces in some of those centers may start to have trouble because of the lack of foot traffic. So I'm kind of I don't know, maybe a hold on retail. I don't think we're going to see a huge increase in rents or transactions. I don't think it's going to fall off the side of a cliff either. I think it's probably just going to maintain what we've seen to this point this year.
Yeah, I think we muddle through in that category. I think that, I think 6 months ago, 9 months ago, I said the era of the enormous number of store closing announcements is over. And by and large, aside from the 150 store closings that Bed Bath & Beyond announced last week, we really haven't seen this enormous shutdown of either inline or department stores. You could argue that pharmacies have been on a downturn for a while, and that's fair. But I do think that these things muddle through. Not a great amount of occupancy improvements, not a lot of revenue improvements, no premium pricing, no enormous demand, but neither will be there a huge shakeout like we saw in even before the pandemic. 18, 19, 20 were terrible for retail with bankruptcies and store closings. And I think that we've gotten a lot closer to being right-sized now than we were 5 years ago.
Did you see the story that was, I think, in the Wall Street Journal, that people are now tired of working out at home, so they are going to the gyms that are in the malls? Now, if you're reading the Peloton news, you probably believe that's true.
I don't know. I don't get the whole working out in the mall thing. I sweat profusely, probably more than 99% of all human beings out there. And, if those floors in the mall get wet, people are going down all over the place. Like they have those really hard, shiny, waxed floors. And it's just a recipe for a lawsuit, and a broken elbow or something. Just a bad mix.
Yeah, I think there was an old adage, like if you're a mall operator and you re-tenant a space with a gym, that's the beginning of the end. It's historically been a very bad sight to have a gym come into a mall space. Now, I think it's become more mainstream lately, given the economic conditions. But historically, that was kind of a very negative perception that you're re-tenanting something with a gym space in a mall.
You ever work out in the mall, Lonnie?
No, I think the only thing that gets worked out at the mall with me is maybe the old credit card sometimes. But I did so back in the day, I had this little Philly cheesesteak place that I would go to in the mall. It's called Phil's Philly. And me and a couple of guys from work would go up there and grab some Philly cheesesteaks. That's about as much. Yeah, in Texas. And of course, when I would go, like, I actually didn't even get a Philly cheesesteak. I would get a ham and cheese sandwich that was like heated up on the griddle. So yeah.
Well, I wasn't on the podcast when you guys were talking about the wedding chapel in the Mall of America closing. That was, what does that foretell, Lonnie, to a mall? Like when you open up a wedding chapel, is it a sign of growth, or is that also the beginning of the end?
Well, we kind of joked, like, I think there's going to be some downstream implications there, because if you're getting married at the wedding, you're probably having the dinner at the food court, and you're probably kicking off the honeymoon on the roller coaster. So if they're not doing weddings anymore, I think there's probably going to be a little bit of a downturn in some of those ancillary tenants at the mall.
There you go.
So last is office.
I'll stick with what I've been saying for a while. I do think that the long-term trend for office is upward in terms of delinquency and distress. I think it will take an awfully long time to play out. The mall story, which is probably a shorter duration story, not because the leases are necessarily shorter, but because so many tenants filed for bankruptcy, which basically took down the duration of the leases in the mall space. That really took all of 5 years to play out. And even now, we've seen very few malls resolved with losses. compared to what could happen still, right? There's still a lot of stuff to play out. I think the office story will take even longer to play out, and therefore delinquencies will run up very slowly. I think the problems will be episodic. As Lonnie said last week, they'll probably be tied to maturing loans. The B's and the C's will be hit more heavily than others. And I think the biggest problem will come from certainly not credit events. I'm not expecting that there, but from smaller demand, and that smaller demand coming at a time where valuations are lower and borrowers have to refinance.
Yeah, so I've been pretty bearish on the office market generally. I've written a couple of things while here at Trepp about the office market and some of the challenges they're going to face. But kind of like Manus had a pivot, 36 hours ago on multifamily. I think this Wall Street investment bank back to the office, Peloton announcing back to the office, Apple announcing back to the office. It's maybe like the boxer that's in the ring. He's about to go down, but he lands one punch and knocks the opponent out. Like, if these firms are successful at getting their teams back to the office, I think that could act as a catalyst that makes everyone come back to the office. Now, when I say everyone, it's not really everyone. Maybe 80% of the folks come back to the office at scale, but that may be enough to tilt the scale back in the favor of offices long term. So I think if, this is kind of a pretty significant event, if we see over the next 6 to 9 months, people really getting back in the office space, I think the sector maybe turns around quicker than we think. I think if this fails though, and in 6 or 8 months, there's a lot of people that have resigned from these large companies, or they haven't come back to the office, or they've, backtracked on forcing people to come in, it may be the death nail for offices.
So Martha, you were in New York this week. What was the vibe? Was it more crowded this week, or was it the same as it's been for the last 6 months?
My own back to work barometer, I will tell you the subway was packed on Tuesday. So people were back to school, people were back from the beach. And for the first time in a long time, it was people jammed into the subway car.
I was going to say our very own Simon H. last night was talking about this as well. He said his trains were about 80% full the middle of this week. And so significantly more than what it had been for the last couple of months. So I think there's definitely, and I was in the city this week, and, the foot traffic around Rock Center and some of the other, places that I would walk past, still not 2019, but noticeably busier than what it has been the last couple of times I've been up in the city.
That's terrific to hear. I wasn't expecting that. I thought there was going to be a lot of noise around the back to the office, but not a lot of follow through. I'm not one to revel in a crowded subway car, but I'm glad to hear New York was busier than it has been in the last couple of years. I'm rooting for that city, my original stomping ground, and I do love it.
And before we dig into some of the office stories, that there was a CBRE report that came out that said that Manhattan office leasing is at its highest point since before the pandemic. So another positive sign from the office sector, especially the New York area.
Fingers crossed.
All right. Do you want to go into a couple of our office hits for the week?
Yeah, I'd love to. None of these are real positive stories. It just could be a slow week or who knows, but I'll run through them very quickly. This is from Rich Bachman of The Real Deal. Vornado is looking to sell one of its financial district assets. In this case, the asset is at 40 Fulton Street, and they're expected to get 20% less than what they were asking for the asset in the spring. I think it's a reflection of both higher interest rates, some volatility in the market, and concerns about the long-term health of the market. This was kind of a big one early this week and late last week. We started reporting on this on Friday. People that get our TreppWire will have noticed this, and we followed it up with another story on Monday. The Peachtree Center in Atlanta backs about $155 million in debt. 115 million is senior debt, 40 million in mezz. The loan had missed its balloon date 3 or 4 months ago. The loan had been with the special servicing. Normally, things don't move this quickly for assets of this size, but a foreclosure sale was scheduled for Tuesday morning. Often when we see these headlines, we expect that there to be an 11th hour stay of execution, if you will, because the lender and the borrower are still talking. An accommodation is made, a delay comes out or something like that. In this case, the property was actually taken over by the lender. And a couple of thoughts about this. Number one, Atlanta is a pretty strong market. And if this is happening in Atlanta, you have to wonder, is this the canary in the coal mine that the office problems are going to be bigger than maybe we thought? Never does one deal or one story make a trend. Certainly something to watch there, because if this thing wasn't taken over by either or cured by either the senior lender or cured by the mezz lender who had a $40 million position in this thing, it means that they think that both think that this is worth far below what the outstanding balance of the mortgage is if they've given this back to the lender. The backstory here is the property is Class B. It lost Truist as a tenant a couple of years ago. They had 20% of the space, but it is in Atlanta, which has been, quite a strong market for a long period of time. So this is a development we're going to continue to watch. But for the meantime, this asset, which backs a single asset deal from 2018, will show up as REO in the near future. Lastly, in Minneapolis, this comes from Kelly Boucher of the Minneapolis-St. Paul Business Journal. Wells Fargo sold its operations center in downtown Minneapolis for $6.4 million. Why did this catch my attention? Well, the property has more than 500,000 square feet. This amounted to $11 a square foot. Now, a couple of things about this particular asset, and I'll let Lonnie weigh in a moment. Usually bank operations centers are a little bit like GSA properties. Once the bank moves out, they're not the easiest things to reposition. That's number one, which probably accounts for a big reason for this. The reason this went for so cheap. Second, Minneapolis, civil unrest issues. And lastly, Minneapolis, several tenants have left including Target, over the last year or two. So a lot of headwinds for this property, but even then, Lonnie, you could have bought that with your petty cash in the Henry household.
Yeah, I mean, $11 a square foot seems pretty cheap, but I think this is indicative. This was a 1979 year built building with a large footprint and a large tenant. To your point, those things are typically finished out for the specific use of that tenant. There's probably more to the story here than what we have in terms of what they think the viability is going forward. This may be a tear down. It may have some other issues because you don't typically see buildings transact. And I think even in the article, it says the property traded, significantly below what expectations were. So I think that's one that, maybe an outlier or is maybe indicative of some broader challenges in Minneapolis. I wanted to go back real quick to the Atlanta office. I had pulled that up. That property you mentioned is backed by some CMBS debt. When it was originated for the 2018 loan, it had a appraised value of about $261 million. So this is one that's had a pretty big fall from grace for them to let it go back. If you look at the occupancy, like Marquee 2 Tower, which is one of the 7 buildings in the portfolio, like 61% occupancy. So definitely something there. It's interesting. I was in Atlanta about 3 weeks ago, Manus, and driving through in the Uber to my meeting, the Atlanta office is dynamic. It has some really big name tenants. It has some really grand buildings. To your point, like on the outside, it appears to be a really strong market. And I actually asked a couple of our coworkers that were with me on the trip. I said, we don't hear about the Atlanta office market much. Like you hear Chicago, Dallas, New York, San Francisco. But when I was in Atlanta, it felt like a major metropolitan city that has a big office presence, even more so than like, say, Seattle. But it just doesn't really register much. We don't hear much about it. So I don't know if you have any thoughts around maybe why that is.
Well, my thought about Atlanta is, it's kind of like the Big Bang Theory. That right, the universe keeps expanding and keeps expanding, never stops expanding after the Big Bang. And that's what I feel about Atlanta, right? It used to be a kernel and it keeps expanding and expanding and expanding. And it seems to me is happening is some of these firms that used to be in the kernel now want to be on the outskirts, right? The Braves used to be downtown. Now they're in that Battery area, which is kind of, 10 to 15 miles away from downtown. Truist has followed them. Truist is now taking space in that area. And if I had a thesis about why the downtown Atlanta area could struggle in the future, it's that this outskirts is so appealing there's so much extra space out there. Commutes are shorter, great quality of life that if there's an undoing in Atlanta over time, that may be it. But other than that, it is a terrific market. Everywhere you go, there's cranes and new businesses coming. They lured Visa, recently Microsoft and others. It would be hard to bet against that market over the long haul. We do have one more credit story. I'll run through this one quickly on office. This was reported, I think, first by Bloomberg. RXR has refinanced 5 Times Square with a $1.3 billion loan. You could look at this as either a green shoot or a crabgrass. I got reactions on email and Twitter that were each. Some people thought this was not a good deal. Some people thought this was a good deal. So let's take the glass half full side of it. The glass half full side is that, RXR has gotten 1.3 billion in financing. The debt was provided by Morgan Stanley, AIG, and Apollo Global. So in that regard, that's a lot of money to put behind a big New York City office. So, office lending cash availability has not disappeared entirely. The glass half empty part of this is it's about 20% less than what they were hoping for 6 months ago. It looked like there was previous debt on the project, which was held by SL Green, which is now being converted to equity. And RXR is going to have to put in about 300 million in renovations to keep this thing relevant. So I'll let our listeners decide whether that's a good story or a bad story. But thank you to Donut Shorts for being the first one to weigh in and send me this story, which, as I said, came from Bloomberg.
Did you see that they're going to add a golf simulator as one of the improvements? I'm all for that.
Yeah, I wonder how that will work out. Like a lot of these places add these amenities, like a gym or, a coffee bar or something like that. And then they're, they sound great, but then you walk by them and they always seem empty all day long. It just seems like more of a cachet thing than a real use. I don't know. Yeah, who wouldn't want a golf simulator in their office? But does it move the needle? I don't know.
For those of our listeners out there that don't know, Martha is a golf ringer. So if you're playing a co-ed scramble, you should reach out because she's pretty dominant on the links.
Thank you, Lonnie. I appreciate the plug. I don't get invited to as many parties as Manus does, unfortunately.
Yeah, I don't really get it either. Sometimes I'm just so negative like this week, and yet still people want to hang out with me. I'm like the Eeyore this week.
That's true. Want. All right, so let's move on. We've got a couple retail stories, and both of them come from our sister company, Commercial Real Estate Direct.
We have a couple here. One was a trading alert. It was a 2011 Texas mall, gets an extension. This was Parkdale Mall and Crossing, has been able to extend to 2026. 750,000 square foot of retail space in Beaumont, Texas. So down here in the Sun Belt region. 73-year built, renovated in 2006, owned by CBL, had a maturity date of March of 2021. Didn't have any delinquency prior to that, but it's resided as what Manus would call the CMBS purgatory for the last 15 months. We've had some commentary over the last couple of months that made us believe this was maybe heading for foreclosure, but most recent servicer notes said that modification was something that's under consideration. And it appears that has taken place. So the collateral was valued at about 150 million at securitization, was lowered to 41 million in 2021. If you're a TreppWire reader, we flagged this loan in the past after the mall lost its anchor tenants, which were Macy's and Sears, but was able to backfill some of that space with Dick's Sporting Good. If we look at the credit metrics on performance, debt service coverage on the net cash flow was a 103 in 21. When occupancy was 98%. It has hovered about the same in first quarter of 22, which was the most recent reporting in our data at 1.01x, with occupancy dropping down to 81%. So some good news on the extension. Don't know that it really clears up any of the purgatory. And at this point, they definitely still have some occupancy issues that they need to address.
Yeah, I think the lesson to take away from this one story is if you're thinking about shorting offices, right? If you think that this office problem is big and extended and deep, this should be your sobering moment, because this was really dead mall walking, right? Past its maturity date, negative equity, DSCR barely in the black, lost anchors, right? This is kind of the kind of thing that you thought if you're a mall short, you're laying your chips on the table thinking that this thing is going to suffer a loss sooner rather than later. And now if you're still in that short position, you have this asset, which this is not CMBX 6, by the way, this particular mall, but it's going to be hanging around again for another 4 years, right? And if it was part of CMBX 6, that's 4 more years of writing premium checks, right? Commercial Real Estate Direct did have a second story. They believe an extension is coming also for South Park Mall. That is part of a 2012 JPM deal, also CBL. And again, this too was dead mall walking, negative equity, past its maturity date, not a lot going for it. And yet this too may be extended. So, place your bets carefully if you think that office is the new mall.
Turning to single family rentals, our analyst Jack LaForge took a look at the SFR market. Beside the fact that he had a very interesting lead-in sentence, so well done, Jack, on making a sports analogy. But it took an interesting analysis of the last couple of years and how the SFR market has changed.
Yeah, so single family rental has been a hot topic, and we've touched on it. We put out some content on this over the last couple of months. But what Jack did this time was look at it from the perspective of the overall CMBS issuance in 2022, what percentage of that has been single family rental? So just for some highlight numbers here, about 13.9% of all issuance through the first 9 months of 22, this is excluding agency issuance, was single family rentals. If you compare that to say 2019, single family rental issuance was only about 3.32% of the overall issuance volume. So there's definitely been a significant uptick in single family rentals. It'll be interesting to see on the go forward if they're able to maintain the pace. I know several of the larger single family rental buyers have announced recently that they're tapping the brakes in terms of that. I actually have a little bit of a theory around that. I think that these folks that are buying the large single family rental properties are realizing that they've single-handedly been keeping the prices high in certain markets because they've been buying so many properties, that if they tap the brakes and let the market cycle itself out, they'll probably be able to buy twice as many homes for the same money as if they continued their buying at the pace that they had. So more to come on that. So I think we may see a slight lull with a rebound when the market starts to collapse a little bit in certain areas. But if you haven't checked this out, and Martha gave us a little bit of a lead in, but Jack effectively equates single family rentals to being as hot as Stephen Curry in an NBA 3-point shooting contest. So if that doesn't get you excited about this, I don't know what will.
And then turning to shoutouts, Brian B. responded to our secondary MSA rankings report about the Minneapolis data. Michael W. is a big fan of the pod. He met with his colleague who would be an upcoming guest on the podcast. So stay tuned. We'll be giving a number of guest pods coming up. Brad C. Allowed shout out to the best and only CRE podcast. I don't know about the only, but the best is a nice little kudos there. I enjoyed the last section on multifamily cap rates, and he asked for some follow-up analysis on some markets that he's given us. So we'll give him some answers on that. Professor Siri on Twitter responded to the delinquency report. Maybe we haven't had the big CRE downturn, and perhaps it's just early. We'll have to wait and see. Cheese on Twitter. I don't know if it's real cheese or cheese food, but Cheese says the cap rate is not indicative of a value add deal. I think he was commenting on one of the stories we were talking about. How Devs on Twitter sent a comment on episode 156, an interesting podcast. So thanks to all who gave us comments, questions, and requests for more information.
We love the engagement. Thank you so much for reaching out. Thank you for your listenership. When we started this, 2 years ago, we didn't think it would be this enduring, and we've made so many new friends, learned so much from this. Grateful for Haley and Martha for spearheading this week, for Lonnie for all his humor and insights, and certainly our audience makes it all worthwhile.
And with that, we'll close. Thanks to our producer, Haley Keene. Join us next week as we look at what's happened during the week and how it may be impacting you. If you have a question or a comment, send your email to podcast@trepp.com and subscribe to the podcast with your favorite provider, maybe except for one. Thank you for listening and stay well.
All right.